Watching markets closely, global stocks kicking off the new year on a down note. All 10 S&P 500 sectors ending the day yesterday in the red. Financials and healthcare were hit the hardest. And this morning, U.S. futures are edging lower once again with triple-digit losses on Dow futures, down 116. But my next guest says there are still pockets of the market that you cannot ignore and that you can make a pretty penny in the new year. Let's bring in Washington Crossing Advisors Portfolio Manager Chad Morganlander. Chad, are you here with some good news, a bright spot in 2016? What are you looking at?
Okay, so first of all, we believe the global economy is decelerating and global trade is decelerating far beyond what everyone's going to be expecting for 2016. With that said, though, there are pockets of opportunities within the consumer discretionary market.
What do you like?
We like companies like Dr. Pepper and Hershey's. We want to go with low momentum stocks at this juncture, low volatility companies. We do believe that you'll get a positive return with the S&P 500 for 2016, but there will be a tremendous amount of volatility. So that big break within the market, that downward pressure.
What kind of return, broadly speaking, are you?
4 to 5%, and that's based off of earnings growth of roughly about 1 to 2%, and revenue growth flat for the year.
All right, so we kicked off the year with this big sell-off in the stock market. Everybody sort of panicked, like, is this going to be the way 2016 is? You probably fielded a couple phone calls. What do you tell people that are fearful of a scary new year? Expect
a 10–15% decline within the market during the year, and when that happens, you have to lean into risk. We would look at themes of opportunity like the high-yield market. If you start to see oil prices go below $30 a barrel to $25 a barrel, we do expect that to come to fruition. We believe that the commodities market overall is going to continue to take a downward slide. There will be lower lows, but there will be opportunities. There's kind of break of the market, this fragility of the market creates those opportunities.
Wow, John, what would the...
So we asked Jim Rogers a few minutes ago if the market is off to is going to have a bad year when it starts off on such a soft note, and his answer was yes. When you see selling in the first 5 days of the year, that's usually a sign that it's going to be a down year. Do you agree with that?
John, the way I would look at the world is global growth accelerating or decelerating? The IMF had in October global growth rate of 3.6%. We believe that number will be close to 2%. We believe earnings growth will be lackluster. Now, it doesn't matter about the 5 days of trading the beginning of the year and whatnot. You want to look at earnings growth within the S&P 500 and ask yourself the question, is it going higher or is it going lower?
It sounds like you agree with him.
I'm agreeing that it's going lower. They had $127 a share of expectations for the S&P 500 for 2016. We're starting the year as a base case at 120.
So history's always been
and it would be a surprise to see it lower.
Good indicator of where things are going. Right. Not a guarantee. But are you saying I should throw away my stock trader's almanac? History doesn't apply here?
No, I'm just saying, look, you can get yourself a little bit, you can go off the road with that map. And what you want to really focus on is economic trends, what monetary policy is, both here in the United States as well as overseas, and where exactly earnings are going. And earnings are not going higher at this juncture.
Dr. Pepper and Hershey's, I think you mentioned, those are U.S. consumer stocks, domestic-oriented consumer stocks. Is that where you want to be looking right now?
I would do that, yes. I would stay with these low-volatility companies. I think utilities also you can make a lot of money in. I think the long end of the yield curve will start to actually go lower, so interest rates will go lower for the 10 and 20 year.
Well, that's what happened yesterday. And Keith's been calling that. Keith's long the TLT. He thinks that you'll get to a 10-year yield that is at historic lows.
Whenever we talk about interest rates going up, they go down in the long end. So, I mean, it seems
right. On the
like
short end of the yield curve, the Federal Reserve, we believe, will go 1 or 2 times. I think we have to come to a realization. Interest rates overseas are negative in Germany, in Switzerland as well. And, the United States and the Federal Reserve at this juncture is going to have a difficult time raising the short end of the yield curve without that applying pressure to the U.S. dollar.
Doesn't that make for an asset price boom if interest rates are going to stay so low?
No.
Shouldn't asset prices be going up?
No, because you hit that critical endpoint at this juncture.
All right,